There's no such thing as a win that's too small to celebrate. If you've got a new ETF and you get a client that puts in, $20,000 or $10,000, or you get your first create, just celebrate. And that was a lot of fun. And now look, we've gotten to a point, so our AUM today is about 70 billion and our ETF AUM is about 5 billion. But it's, to get from 0 to 5, like, it is a real tough slog. But we're just at that point now where we're beginning to see like accelerating growth.
Yeah.
And that again is just fun and gratifying in a different way.
That's Kristof Gleich, the CEO of Harbor Capital Advisors, a $70 billion multi-manager platform that partners with external fund managers to build and distribute active strategies. Kristof joined Harbor in 2018 after nearly 2 decades at Goldman Sachs and JP Morgan, where he ran a 60-person global manager research team and oversaw $500 billion in assets. At Harbor, his focus has been on bringing the firm's active management expertise from mutual funds into ETFs, and he's delivered. Since 2021, Harbor has launched over 30 active ETFs and grown ETF assets from $0 to $5 billion. They work with long-standing partners like Jennison Associates, a 52-year relationship, alongside emerging managers like BlueCove in fixed income and Quantix in commodities. Their commodities ETF has passed $1 billion by rethinking index construction from first principles. We talked about his Polish refugee heritage, what Crystal Palace's FA Cup win meant to him, how he thinks about backing emerging managers, his gold and debasement thesis, and why he believes there's no such thing as passive investing. I want to just go a bit way back. You're a Crystal Palace holder at Selhurst Park.
Yeah.
You've taken your 3 sons there. You're kind of an avid fan.
Yes.
Where'd that love come from? And yeah, just tell me a bit about your passion for Crystal Palace.
So I anybody that knows me knows this. I'm a massive Crystal Palace fan. And it's not something I've ever grown out of. And in fact, the older I get, the more I think sort of passionate I get. So they're a South London football team, as in soccer, but football, they play in the Premier League. They haven't always been in the Premier League, but they have for about the last 10 or 11 years, really kind of coincide. They got good when I left the UK and moved to the US. I love football. I think it's a very entertaining game. I love watching it. There's a lot of parallels with, I think, sport and our industry. Just the continuous innovation. Like, you think the game's rules have effectively been set for, 100 years or so, and there's changes here and there, but there's constant innovation within that rule set, gone through like a data revolution, which is really, really interesting. But I began watching them with my dad. So there's that emotional bond that I had with my dad. And I've got 3 sons, and I love, watching the games with them. I love taking them. It doesn't happen so often, but I took them all to Wembley earlier this year for the FA Cup final against Man City, and that was a classic kind of David and Goliath. We were the underdogs. We'd never won anything in our it gives me goosebumps just talking about it. 140-year history, and we won the FA Cup, and it was. One of the best moments of my life, and just to be there, have my dad there, my kids, it was, just amazing, and they're just a big part of who I am.
Speaking of your dad as well, I know that your parents also came to the UK as Polish refugees after World War II. That heritage and drive, how has that translated for just your career in general, but also your personality and character trait into work ethic?
I suppose I've always been a little bit of an outsider in that respect. That I grew up. I was very fortunate that I was born in the UK, and that just the Brits took in a bunch of Polish refugees after the Second World War, and my grandparents ended up in the UK on both sides. So I'm very fortunate of how my life began, and I realised the role of luck that was played in all of that. So I guess I'm aware of the role of luck and the role of chance, which is helpful in investing and sort of in finance. It keeps you grounded and keeps you humble, hopefully, but also it's an important thing to understand. When you're looking at things like luck versus skill and not getting carried away, and I've lived and breathed that, I suppose. And I suppose I've always felt like an outsider, growing up in the UK, but very much growing up sort of in a Polish family with Polish traditions in the UK. And I've carried that forward with me. And I suppose I've given my kids exactly the same kind of experience now, and that they're probably feeling similarly being here. But yeah, keeping humble, resilient, and I go tying this back to Palace, I suppose, a little bit. I like that outsiders, I like being part of the underdog and being more David than Goliath.
I want to jump into Goldman because I know that you jumped literally right in after 9/11 in 2001. What made you decide to go the finance route early in your career? I know you studied physics. That pivot into finance, what was the motivation there?
So I studied physics at undergrad, and I liked physics, and I still very much like physics. I like the way it sort of taught me to think. I like the sort of scientific process, the scientific methodology. I like understanding how things work from a first principles perspective. And I think the best thing that physics ever did for me was sort of teach me all of that. But I wasn't a physicist. I wasn't good enough. I don't think I was clever enough. And if I'd sort of stayed in physics, I would have been a second-rate, third-rate physicist. And I have three older brothers, and my eldest brother worked in the city. So that's kind of like the London equivalent of what we refer to as Wall Street here in the US. And he encouraged me to look at finance as a profession. And after learning about it and doing some research, I decided it all sounded quite exciting. And I took the plunge, and I was very lucky to get on the graduate program at Goldman Sachs. I look at the graduate qualifications that you need today, and they dwarf anything that you kind of needed back in my day. And so I joined Goldman straight out of university, and again, very fortunate to have landed somewhere like that. And it gave me an amazing entry into just growing up and having a job for the first time, let alone sort of into finance and the whole sort of career. And I got an amazing exposure and training there, and very, very grateful for everything that I learned from all the people that I learned along the way.
After Goldman, you went into JP Morgan, and you ran a 60-person team at JP, and you were also overseeing around 500 billion. What was that transition like culturally, but again, going from Goldman to then the responsibilities at JP Morgan?
So I guess there's sort of some similarities between Goldman and JP Morgan. By the way, I never grew up thinking I was going to work for these gigantic financial investment banking type organizations. But I did. I spent almost 20 years at the two really good firms. So JP Morgan was where I learned and cut my teeth in leadership. And a lady there called Jamie Kramer hired me and gave me my first opportunity to lead people. And I loved it. And so I'll be always very grateful there. And that's sort of where I ran firstly a 15-person team in London. And I ran the manager research platform in London for the international private bank. So LATAM, EMEA, and Asian client base. And, really sort of, learned my first experiences of leadership there and from her. She's an amazing lady. And then they asked me to kind of take on her role when she moved internally. They asked me to move to New York and run the team globally. So that was a sort of 60-person team, 500 billion of assets under management. And again, a tremendous responsibility. It was definitely some lessons that I had to learn firsthand from managing a smaller team to managing a bigger team. You can't manage that in the same way. I'm very sort of practical and hands-on. I rolling my sleeves up figuratively and literally, when I'm kind of really getting into something. And when you're all sat in a space where you could throw like a reasonably sized fishing net over all of you physically and catch you all, you can be much more in the moment of sort of creativity and innovation and sharing ideas. When you get to do things at a bigger scale, more globally, you have to be much more intentional and deliberate and process orientated and organized. And so I sort of learned that transition, going to JP Morgan. JP Morgan's an amazing firm. I love Jamie Dimon. I think he's such an awesome leader and just, one of the best that we've ever had. And it was, again, a privilege to have played a small part in that organization. Great firm, but just sort of decided that I wanted to make a change.
Yes, and that change involved moving to Harbour around 2018. When you first joined Harbour, what was the first strategic decisions you were making to reposition the platform, and how did you carry those skill sets and experience from JP Morgan into the leadership role at Harbour?
Yeah, so I think, the first big decision I made was to join Harbour, and I did that. I love the asset management industry. Both at Goldman Sachs and at JP Morgan, I was on the wealth side and involved in investing with external money managers. So finding what I thought were best-in-class money managers that could deliver positive value for our clients and getting them on our platform and getting our clients invested in them. So I'd always been sort of a client of the asset management industry and just enjoyed the long-term nature. I remember someone telling me that asset management was much more like farming and investment banking was much more like hunting. I just that long-term nature and sort of building things with a multi-year view, if not a multi-decade view, really appealed to me. And so I wanted to cut my teeth on the asset management side. And the way that Harbour works, the way that we work, is we work almost exclusively with external fund managers. So we find external fund managers outside the four walls of Harbour, and we partner with them to run our funds. And so they do the day-to-day decision making. And it was a time, so this is going back to 2018, and the industry was and still is in a degree of transition and disruption. Like active management and actively managed mutual funds were what we did, and that was not what the industry wanted. And it was taking on an opportunity to join a firm that had lots of what I thought was potential, but putting in a new strategy in place to try and help the business grow again. And so what I used to say in my early days was kind of taking potential energy and translating that into kinetic energy. And that's sort of what I've been doing. And so our first, big strategic initiative really was probably active ETFs. And it was a doubling down on active management, but doing it in a way that we thought would have more receptivity in the marketplace.
Did you initially think that you were going to launch as many active ETFs than you currently have? Because I know you launched more in 4 years than most mutual funds in 40.
Yes.
Was that process kind of linear or was it exponential?
It was probably more exponential. I don't think we had a plan to sort of say, look, over the first 4 years, we'll do exactly this, right? Because what I've learned is planning is important, but it's more important to kind of set a true north, to set a direction of travel, so that you can get everybody kind of going in the same direction. But you can't be overly prescriptive with exactly what that's going to look like along the way, because you don't know until you kind of get there. And I think that's part of the joy and part of the fun and why it's really interesting in any industry, and this is the industry that I know. So if I sort of said when we began, we're going to launch, 30 plus ETFs, I don't know, could it have been 20? Could it be 40? Could it be 15? And so the way that you get the organisation moving and sort of rowing in the right direction is it's a strategic decision to double down on active management in the ETF wrapper and to establish ourselves and to have the goal of establishing ourselves as a leader in active ETFs. And then it's trusting the people that we have to kind of take us on that journey to kind of get there and react to all of the different opportunities that may present themselves along the way. And so that was more of our approach. If you'd asked me at the beginning, would I be surprised at the number that we've launched and how aggressive we've been? I think I probably would have. Yeah.
How has that evolution of ETFs evolved? Is it easier to raise capital for your current ones compared to the beginning? And what's the focus now? Are you still looking to scale it as aggressively?
Yeah, so I think the hardest thing to do in our industry, I'll be careful about that superlative, but one of the hard things to do in our industry is when you start out at something and you don't have a track record. And even though we've been doing actively managed mutual funds with external managers for since 1986, we've only been in ETFs since 2021, so about 4 years now. And when we began, we were no one in ETF space. We had no experience. So it was about leveraging the skills and the experiences that you have from mutual funds, but trying to figure out like how ETFs are different. And it's very difficult in the first few years to scale. It can be a bit demoralizing because you think you're kind of onto something, but then if clients don't allocate to you, then kind of who cares? What's the point in what you're doing? We had to hire a number of salespeople to help us. I'm very, very grateful to all of the early adopters that we had from these salespeople that could have really frankly worked anywhere, but they chose to come and work for us and they bought into our vision. And you've just got to put yourself out there. There's no such thing as a win that's too small to celebrate. If you've got a new ETF and you get a client that puts in $20,000 or $10,000, or you get your first create, it's just really exciting. You look at the volume, you start to see on Bloomberg or whatever platform you're on, and you're like, wow, like there's people are trading like in our ETF, meaning there's volume, there's buys and sells, and so you just you want to, any kind of early success you get, just celebrate, and that was a lot of fun. And now that we've gotten to a point, so our AUM today is about 70 billion and our ETF AUM is about 5 billion. But it's, to get from 0 to 5, like it is a real tough slog. But we're just at that point now where we're beginning to see like accelerating growth. Yeah. And that again is just fun and gratifying in a different way. And in part where you sort of start to look back and I sort of almost miss the old days as like a complete upstart, but actually you don't. It's just you have to be aware that you're now transitioning to a different phase of your life cycle, and going through that transition to a different phase requires different opportunities, different problems, and we're sort of making that transition now, which is pretty cool. So I don't know in the future if in 4 years' time, will we have 60 ETFs? I don't think so. The purpose of what we're doing isn't just to launch more ETFs. It's to be intentional. It's to be thoughtful. It's to try and have a highly curated offering that is delivering value in the marketplace. But as the world evolves, as the markets evolve, as different investment themes evolve, we'll naturally evolve and innovate with it. It's really interesting.
$5 billion AUM in 7 years is quite impressive, and I know the scale is going to continue to grow exponentially. Also, in around 2018, you were backing emerging managers, I know, like BlueCove, that launched in 2018. And you also have existing strong relationships. I know you have been a partner with Jennison for 52 years. How do you think about portfolio construction at the manager level, and also balancing those kind of anchor partnerships with emerging talent?
So I think it's a really good question. So the anchor managers. So we have a relationship with Jennison Associates. They're sort of a growth-oriented public equity active manager, and they run some large growth mandates for us. And look, we've had a relationship with them for over 50 years. Clearly it predates me, and it will continue long after I'm gone as well. And so having a relationship as special as we do with them is unusual. And when I came in, it was to be respectful of those relationships, but to try and look at them with a fresh perspective and make sure that we are maximising the value of that partnership, and we're complementing each other as much as we possibly can. And so with Jennison, that meant launching something called the CIT, and then we launched an active ETF with them as well. And our relationship, I would like to think they would say this as well, and it's never been stronger than it has been today. But we've got to make sure in 12 months' time or in 24 months' time that it's true then, and it's stronger today. So you've got to continuously invest in each other and invest in the relationship, and then at the same time complement our portfolio with newer managers, newer exposures. The world is constantly changing, and if you're open-minded, you can always find opportunities. One of the bugbears I have about our industry is our industry invests in the future, but the way that we approach ourselves can be quite static, meaning we seem to value a manager that's been doing something a certain way, or an investor that's been doing something a certain way for 20 years and never changed. Because there's a whole sort of consultant community that view consistency. And consistency is important, but it can't be at the cost of innovation and continuous improvement. And so I think having that mindset of being open-minded, open to challenging yourselves that there may be a different way of doing things, and having a bar of expectation of continuous improvement is really, really important. And so, you mentioned the manager, BlueCove. We've been working with BlueCove. I began conversations with BlueCove probably in 2018, 2019, something like that. And then we've had live, AUM invested in BlueCove since 2021. And they're a systematic fixed income manager based out of London, and they're looking to disrupt an entire industry like fixed income, a multi-tens of trillion dollars industry, by taking a disciplined, scientific or systematic approach to uncovering and discovering value and undervalued securities within fixed income, and doing it in a fully automated, systematic and scalable way that up until a few years ago wasn't possible. It wasn't possible for a number of reasons, just from a liquidity perspective. The way fixed income used to be traded, if you'd said to someone 10 years ago, you could have a sort of a fully automated way of investing in fixed income, just there weren't enough electronic trading platforms. There wasn't enough the price discovery in the market. There wasn't enough data to do the research on all of these different signals that you need to build. And, over time, that begins to change. And as that begins to change, it unlocks new ways that you can then discover value. And, I love betting, and still do, on a firm like that, where you have 65 people or so, and they've taken this big professional commitment where they're going to bet their own livelihood on them succeeding. And so from an alignment perspective, you can't have a better setup, that you've got, 65 people that are betting their livelihood on being successful and doing something differently. And then to get to partner with them and launch ETFs is just a privilege. Work with managers, and Alex Khan, the CEO, he's got an amazing team that he's built, and we're doing everything that we can to help establish a BlueCove in the US marketplace, because we think what they do is very different to common-based approaches, which results in hopefully strong risk-adjusted returns with a low correlation to existing styles, which obviously if you can provide strong returns with a low correlation, you're enhancing returns and you're reducing risk fine, which is what we're all trying to do.
Yes, incredible partnership there. I would love to jump in on the product side as well. You've got your Alpha Edge Small Cap Earners ETF. You've got the Disruptive Innovation ETF.
Yeah.
You also have the Commodity one as well. How do all those products come together, and what are the most recent innovations and developments in those specific ETFs, or ones that you're excited about?
Yeah, why don't I talk about commodities at the moment? It's pretty timely.
Yeah.
So we have an ETF run by a firm called Quantix, and they're based in Greenwich in Connecticut, and they are a commodities boutique specialist investment firm. They run hedged money and they run long only money, and we're their long only partner. And they came out of Goldman Sachs. So Don Castoro, who founded Quantix back in 2016, 2017, he'd been a partner at Goldman, and he had helped run their trading division in commodities for over 20 years. So he had sort of been there, seen it, bought the postcard for anything commodity trading. And we had a view about 3.5 years ago that commodities were going to be more in need, like just more valuable as a source of returns and diversification for portfolios. And so we partnered with them to create an ETF, the ticker's HGER, HGER. And we structured it as an index fund. And I mentioned earlier that we're an active shop. And you're like, well, hold on, what's going on there? I thought you were an active shop. I don't believe that, index investing is not the opposite of active investing. In fact, there is only active investing. There's no such thing as passive investing. Like, there's no perfect benchmark for anyone. Like, whether you're expressing an active view through a discretionary, actively managed bottom-up portfolio, or you're taking a top-down allocation decision to certain indices, it's all active management. But there are investors that prefer things presented as an index fund. They like the rules-based, systematic discipline that goes into creating index rules. And so we created an index that we believe at the time, and still do, had a far superior way of creating a diversified exposure to commodities than typical benchmarks in commodities at the time. So the S&P 500 of commodities is the BCOM index, the Bloomberg Commodities Index. But it was never designed for investors to invest in, but it became over the years like the de facto benchmark for commodities. So you now have like multiple, tens of billions, if not hundreds of billions of commodities investments tied to or with tracking error constraints of the BCOM index. And we wanted to create an index from scratch that was created for investors. And so again, it was going back to that sort of first principles thinking of like, well, what should a commodities index look like? What are investors looking for? They're looking for things, they want commodities to do well in periods of inflation. Okay, so you should have some kind of inflation trigger in your commodities allocation where you want exposure to commodities that are going to give you better protection during periods of inflation. You need to be very thoughtful that, commodities can be in backwardation or in contango. And there's a clear benefit to owning commodities over the long run that are in backwardation rather than contango, because you're effectively being sort of paid carry to own those commodities rather than paying carry to own those commodities. And then there's different types of inflationary environments, such as scarcity, or as a contender for word of the year at the moment, debasement. I hear this word everywhere now. And if you're in an environment of debasement, then something like precious metals or gold versus an industrial type commodities or consumable commodity exposure, there's a clear preference. And so it was sort of rethinking from scratch, from first principles, delivering something in an index. And, we've now passed $1 billion in that ETF. And I remember, as clear as yesterday, talking about this concept or an idea for an ETF, when the reaction was like, why does anyone want commodity? No one invests in commodities. Like the 60/40 is fine. And you think of everything that's happened, you think about the environment we're in now. And it's just, again, it's nice, it's gratifying to sort of see an investment concept go from concept to adoption. And, knock on wood, we've delivered really strong returns for our clients as well. So it's been pretty cool to work.
You've been quite bullish on gold and also the de-dollarization and reserve diversification there. With this ETF as well, where do you see the general market going and the demand for this ETF in the near future?
So look, I think commodities are under-allocated for the everyday investor. So if you look at the commodities allocation assets as a percent of all assets, so if you go to like Morningstar and you look at like what are all of the investable assets in Morningstar, which is ETFs and mutual funds, and you look at how much are allocated to commodities, roughly 75 cents in every $100, 0.75%, is invested in commodities, and everything else is invested in alternative equities and fixed income. And I think that's a misrepresentation of how clients should be invested in commodities. And I think an allocation to things beyond the 60/40 portfolio today should probably be in the 10 to 20% range, and that commodities should play a much more meaningful role. So you can justify with a product or an ETF like HGER, you can justify from an efficient frontier perspective an allocation above 10% in commodities as a return enhancer and a diversifier. I think debasement has become this word that is gaining adoption this year. And what does it really mean? Like when people ask me why is gold up so much this year, I think it's often helpful to reverse the question slightly and say, why are fiat currencies losing purchasing power versus gold this year? Because it's not just the dollar. It's, the dollar story was a bit more of a story in the first half of this year. You obviously had the unorthodox trade policies coming out of DC. You saw a historic weakening in dollar versus other currencies in the first 6 months. So now it's a fiat currency devaluation versus gold. And if you look at what's going on, you've got record levels, globally speaking, you've got record levels of debt and you've got record levels of deficits being run in an expanding economy. And these things are not sustainable. And I think when you take that as a starting point, you look at the way the world is going, the world is becoming sort of more fragmented. So these decades of kind of more globalization that really took hold from, when China joined the WTO in the early 90s, really up until the financial crisis, and it continued beyond the global financial crisis. That now feels like it's well and truly, in retrenchment. And then you have central banks buying gold reserve, assets as part of their reserve assets. You've got a number of very powerful forces at play that are driving, gold prices higher. And I see that continuing. If you look at what happened in the 1970s, which is probably from a gold perspective, the closest parallel that we've got today, gold went up 15 times roughly from 1970 to 1980. It hasn't gone up anywhere near that amount. it's very hard to put like a fair value, but I think the way that gold is telling us something about what the markets are predicting about the future state of the world. And I don't see anything in the medium to longer term that's going to stop that. You know, can gold have a big correction? Sure. But to be devalued significantly from here, I think maybe it would be like a positive geopolitical shock and probably an AI productivity boost that would bring down, that would push growth up very, very abruptly and bring down debt levels through growth for gold to kind of come down, meaningfully.
Yes. If we look ahead now for Harbour in general, 2024 was in a way an inflection year with 4 billion in net inflows. What does the next inflection look like? And also for your career compared to when you started to now, what's the next goal that you're looking to achieve?
So, I think sort of the next inflection point, hopefully for us, is just our ETF really breaking through to the mainstream, and helping a number of our, talented managers that we work with, helping them get to where they want to be, from a growth perspective. And so you can hit a point in our industry where things begin to sort of super scale and you get that exponential growth. And I very much, again, sort of knock on wood, hope that we're there right now. And so sort of enjoying that, journey. But, when you're a small upstart and you kind of then break through, you start to get noticed by people, and then there's competition in different ways. And so you have to reorient yourselves around how do you react to that competition? How do you make sure that you stay hungry? How do you make sure that you continue to disrupt yourself before somebody else is going to disrupt you? And so culturally, just making sure that you keep hold of that hunger and desire, and that you keep on the front foot, and that you keep sort of disrupting and innovating. Personally, from me, I just want to continue to help more of our clients grow. I want to continue to help generate strong returns for our clients. I want to continue to help our managers that specialize continue to compete with and, continue to try and punch above our weight. Sort of again, comes back to that sort of underdog mentality. I never want to lose that underdog mentality.
Yeah, love it. Well, I look forward to seeing Harbour scale the ETF even further and remain in that competitive edge. So thanks, Kristof. It's been incredibly fun, and hope to circle back potentially in the future.
Yeah, Aidan, thank you so much. That was a great conversation. Thank you.